Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for February 2017. Now, when we talked last month, I talked about how the tanker market was still showing some strength from December into January. The rates have come off a little bit into February, but that's quite normal with the seasonality. Oil refineries start to go into maintenance in February, starting with the United States, and then it tends to go to Europe in March, April time. And then the Asian refineries tend to go into maintenance more around April, May time. I do think the refinery maintenance schedule will be quite heavy this spring. The past couple of years, refineries have been making pretty good margins, so they've been deferring anything but essential maintenance. But I do think this spring we'll see up to 6 million barrels a day offline at the end of March and the start of April, so it's a pretty heavy maintenance schedule, and that's putting some downward pressure on tanker rates. And what we're also seeing is the impact of the OPEC production cuts. So as you'll recall, OPEC in November announced that they were going to cut oil production by 1.2 million barrels per day starting in January, and we're starting to see those cuts coming in. In fact, the compliance with those cuts is pretty good. It's about 90%. So OPEC is doing what it said it would do. It is cutting volumes, and that's having an impact on tankers, especially those that load out of the Middle East, so the VLCCs and the Suezmaxes. But the market isn't uniformly low. I think what's interesting at the moment is that we are seeing some volatility in different parts of the world, and that's really being driven by an increase in long-haul exports from the Atlantic to the Pacific. And that's due to a couple of reasons. Firstly, as I said, OPEC is cutting production, and that means that buyers in Asia are having to source oil from elsewhere, and they're pulling a lot of volumes from the Atlantic over to the Pacific. And because OPEC has cut volumes, that's increased the price of Middle East crude relative to Atlantic crudes. So there's an arbitrage that has opened up to carry oil from the Atlantic over to the Pacific. And we've seen some pretty interesting trades emerging from countries like Brazil, Libya, the UK and the USA as well. If you take those four countries, back in October they exported about 10 million barrels to Asia. In February they're exporting 35 million barrels. So it's a big increase in oil coming from the Atlantic over to Asia. And I think that's going to be a key feature of this year, is that the OPEC cuts are negative. We've got a lot of ships coming into the fleet this year, which is negative. But this long-haul trade emerging is going to create some pockets of volatility. And that could increase going forward. We're seeing some interesting stuff in the United States. Last week, the US reported that they exported 1 million barrels a day, which is a record for the United States. And some of that oil is going short haul to in the Caribs region or to Europe or to the Americas. But some of that oil is going long haul to China. And we saw the first ever cargo of US Gulf crude going to India a couple of weeks ago as well. So that was pretty interesting. So like I said, we do think the market will soften through 2017 because of OPEC cuts. Fleet growth is about 5%. It's a bit higher on the Suezmaxes. The Suezmaxes. It's as high as 8%. But we will get, I think, these pockets of volatility from the long-haul exports, which stretches the fleet out. And that's going to mean that the tanker rates probably will fall, but I don't think they'll fall as low as they did in the period 2011 to 2013 when the market was really poor. And we remain very positive about the market from 2018 onwards. When you get into next year, I think the OPEC cuts will have rebalanced the oil market somewhat. Inventories will have come down. And at that point, I think OPEC could push their production back up, so more cargoes on the water. Oil demand is still growing very strongly. And when you get to next year, the fleet growth, which this year was 5%, last year was 6%, by the time we get to next year, it drops to about 2 to 3%. And I actually think there's some upside to scrapping as well. The fleet is getting older after a couple of years of no scrapping. And I think the regulations that are coming into effect in the next couple of years, particularly ballast water, might also encourage some more scrapping as ships reach their, especially fourth special survey date. So all those late 90s built Aframaxes will start to be scrap candidates once we get to 2018, 2019. So we think that 2018 is going to be a recovering market into the back end of the decade, when I think it actually could be a pretty strong market going through 18 into 19 and 20. So that's our conventional tanker market update for this month, and we'll talk to you again in March.